In this episode of the How to Be a Trader series that we're doing for the community here at High Tide, we're going to be talking about a concept called the Trader's Triangle. Now what this is a 3-step process for traders to follow when returning to the charts. Whether it's the first time you come to the charts in the day or if you just had a lunch break or whatever, you can follow these 3 simple steps to familiarise yourself with what price is doing. I've been using this myself now for a few years and it's really helped to get that structure into my game. So I've always thought it's really important for traders to take a break from the charts. Whether you've been trading for 20 minutes or 2 hours, if you're feeling a bit of exhaustion, you've got to go and take a break. Whether you have a coffee or some fresh air or even, your lunch break, it's really important to take a break. But when you return to the charts, I think it's a good idea to have some kind of system to follow to familiarize yourself with what price has done. So that's where the Trader's Triangle comes in. All it is a pretty name that I've given to a 3-step process that you can follow to update yourself with where price is at and form a plan for the session ahead. So here they are. Here's the 3 steps that I follow when I return to the charts. The first thing I do is identify those key levels. Then I look at where the momentum's at. And finally, I plan for a formation to execute on a trade. So we all know how important key levels are. It doesn't matter how you identify them, whether you're using horizontal zones or Fibonacci retracements, and we're going to get into this. It's really important to familiarize yourself with where the key levels are at. You could be at one right now, you could be a couple pips away from one, or you could have just reacted from one. So you need to know where your key levels are. Secondly, your momentum is really important. There is obviously cases where you can look for buys and sells at the same time. Maybe you are looking for a breakout or a reversal at a key level. But it's just important to know where the momentum's at. What's your higher time frame trend? What's your lower time frame trend? What's the intraday candle doing? What's the intraday momentum? These kinds of things are very important to just give you a clear bias. And we're going to get into this too, obviously. The final thing is formations. Once you know where your key levels are and you know what the momentum is saying, you need to plan. You need to ask yourself, what formation is it going to take for me to actually execute a trade at this point? And that's kind of the final stage. Most of the time, you know where your key levels are, you know what the momentum is. And it's just a waiting game to wait for a formation that you're familiar with to then go ahead and execute a trade. So these are the 3 things that I follow to update myself and form a plan for my trading session personally. And we're going to get into each of these stages now in a bit more detail. We're going to start off by talking about key levels, and we're going to talk about what to look at and what to use. So this is a bit subjective. You can kind of use whatever you want, but these are the processes that I follow to update myself with key levels. I start off by looking at the higher time frames. So I use top-down analysis actually to identify my relevant zones, and then I adjust those zones as I work my way down the time frames. And I make sure these higher time frame zones are lining up with historic reactions, right? So when you're looking for key levels, all you're really looking for is areas that the market is reacting to. And you want to see if this lines up with psychologicals as well. It doesn't have to, but that's a little bonus there that I've put on. Do your zones line up with significant numbers like integers or QPs? So for those of us who are trading GJ at the moment on our calls, we're currently dealing with like the 150 region, 155, 155, 200, 800, these kinds of things. And this is one of the benefits of being a one pair trader, is you really get to know where those psychological levels are. So what do you want to use? As a price action trader, I've argued that horizontal levels are the most important thing. You can use rays or lines or boxes, whatever you want. Just get those horizontal levels on your chart. You want to see if that's lining up with a trend line if you can. And I recommend avoiding forcing a trend line onto your chart. I think it's an easy trap to fall into as a trader, is kind of forcing trend lines onto your chart. You want to make sure that your trend line is clear and obvious and you're getting a good few touches of that trend line. Fibonacci's is a little differential that I've put on there. I know some people don't enjoy using fibs. It's completely up to you. What you use is obviously subjective with this key level section, but I enjoy using fibs. Time and time again I see reactions of those fib levels. So you really want to utilize those impulsive moves in the market and just familiarize yourself with where each Fibonacci retracement level is. Like I said, time and time again, I see reactions of levels like the 50% or the 618 region. So it's just worth trying it out at least and just familiarizing yourself with where those levels are. So I've jumped into a chart. I figured, if we can look for key levels on gold, then we can pretty much do it on any pair. So I'm going to see how quickly I can actually identify my key levels here on gold. Straight away on the monthly, remember we start on those higher time frames. I'm seeing a level up here. I'm also seeing a level by here. This is where we're at right now. And then you got a couple levels down here. I'm not going to bother with these ones because remembering this is the monthly. They're so far away that they're not too important to us anymore. So I can actually delete this one up here as well. And I'm just going to keep this one in the middle here, which is where we're at right now. So I can go down to the weekly now and just tweak this so that it's more relevant, more accurate. I can bring that in, bring this up a little bit, bring that down. So that I'm happy with that weekly level there. Now I can start looking for other weekly levels. So remembering there's a couple tools we can use. So I'm going to actually draw this trend line from this high off those two wicks, and now I'm seeing a bit of a break of that trend, also a bit of a retest. That's lining up very nicely with another horizontal level down here, which I can mark up. So straight away already we're 30 seconds in, we've got two levels. We can see that we've broken a trend line, retested that trend line. What else can I do here? I can draw another level up here. So we're seeing this level. This is made quite obvious as well because of this wick here, which is really good. So that's lining up with a touch of trend line also. Can drop down to the daily now. Something else I can do is actually use this significant high and this significant low to draw a Fibonacci retracement. So if I draw that there, I'm seeing that the 50% lines up pretty well with the level I've drawn down there. I'm also seeing, if I go back to the weekly, I'm also seeing some kind of reactions here around the 618 area. A couple wicks here, some bodies there. I'm not going to worry too much about that one. I can actually change where the high of this fib is to see if that shows me some interesting things, which it does. So we got the 786 lining up with that level we've already drawn. So I didn't necessarily need to draw that fib to identify those levels, but it's just confirmed to me that the market is aware of it, and I'm merging those confirmations together. So I'm going to take that fib off. I'm going to go back down to the daily. Now I can really just zoom in and start to dig into this area that we're at right now. So if I zoom out here, okay, let's have a look then. So we got this resistance here. We know that this resistance is pretty clear. That's lining up roughly with 1910. So I can delete that level now. I can clone this, start making this a bit cleaner. So far I've got two daily levels. I've got a resistance and a support. I've got this trend line. This trend line isn't actually helping me much anymore. I know that I've broken and retested that on the higher time frames. I'm more concerned with more recent stuff now. So I'm going to see if I can draw a trend line, maybe something like this from this low here up there, just touching that wick. I'm quite happy with that trend line. I've got 1, 2, 3 touches of that trend line, so I definitely haven't forced one onto my chart there. I can zoom back in now and maybe even drop down to the 4 hours already. So I'm just looking at the 4 hour candles now. They're telling me to raise this slightly. That's fine, I can do that. And lower this one a little bit as well. Lowered that now, I'm happy with that. Now I just need to look for a few more areas, see if there is any. Something that's sticking out to me straight away is kind of a midpoint. So I can draw this one here. And that's kind of showing me a region in amongst this range here that I've drawn using the higher time frames. Kind of like a midpoint. We're treating it as a support here. We then eventually broke it, retested, treated it as a resistance. So the market's definitely aware of this level. So I'm now happy to add that one onto the chart. Can go down to the 1 hour now. Maybe refine this now. I know it's in that area. So if I just delete that, redraw it like this, I'd say that's fine. So now I know, I know what price is doing. I know where price is at. We're going to move on to momentum in a little while, but for now we're just concerned about key levels. We know there's a big resistance here, big support here, and then we kind of got this midpoint here that we're dealing with. So we can now use these levels to plan for trades. So at this point, we know what our key levels are. We know where they are. We've got them marked up on our chart. Now we need to consider the momentum of the market. So in relation to momentum, there's a few things that you should know. You should know the trend of the market you're in. Are we making higher highs and higher lows, or vice versa, lower highs and lower lows? Secondly, you should consider what the daily candle is doing. You should always avoid buying a pair if the daily candle is bearish, and vice versa, selling a pair if the daily candle is bullish. You're just putting yourself again at a disadvantage by trying to fight the market. Once you've considered what the trend and the daily candle are doing, you should probably take a look at fundamentals. Now, I know a lot of technical traders don't like looking at fundamentals, but you want to make sure that your position or idea is justified by market sentiment. Now, what I mean by that is, if you're buying the pound, do you know how strong the pound is in relation to its other competitors? If you're buying the pound against the yen, but the pound's moving down against other currencies, then it's probably not a smart move. So always familiarize yourself with the strength or weakness of the currency that you're about to place a position for. So when we left gold, we had a couple levels marked up on the chart. The first was this support down here, roughly 1870. Then we had this resistance up at about 1910, and then this midpoint that we briefly spoke about. So now what we're going to do is analyze gold and try and identify what the momentum is saying and what direction the pair could be moving in due to that momentum. So starting on the daily, we can see that we have got a bullish trend, and we drew this trend line when we were looking for key levels. So straight away we know that we're making higher highs and higher lows on the daily time frame, and this has been happening now for quite a long time, about 2 months. If we zoom in, we will notice that the current daily candle is actually bearish, so it's probably not such a good idea to buy whilst the current daily candle is bearish. We know that the trend is bullish, so we'd rather buy. So what I'm going to do is draw a horizontal ray to tell me when that daily candle flips bullish. So now I know that it flips bullish here at roughly 1900, and I can take that information down to the lower time frames. So now we're starting to see where that daily candle will flip bullish, and it is indeed around this resistance area. So if I now draw a level here on this resistance, I know that above that resistance the daily candle will be flipping bullish and will be breaking the previous 4-hour high. If I delete that horizontal ray now, I can start to make a plan based on this information. We're now down on the 1-hour time frame, and we have 3 levels that we can use to identify trading opportunities. We've identified that 1902 is the level at which the daily candle will flip bullish. There's also a clean range to the left between 1902 and the major daily resistance that we identified on the higher time frames. That range is roughly 100 pips, so we'd like to buy above this region. Remembering that the overall trend is bullish, we're simply not interested in any of this bearish movement. We're just going to wait to see if an opportunity to buy gold above here does come. Something else we can do is reference the dollar currency index chart. If the dollar is moving down, then that confirms our bias of buying gold. So we know where the key levels are in the market. We also know where the momentum is in the market. The final stage of the trader's triangle is the formation stage. So as a trader, you constantly need to be asking yourself, what do I want to see? To then anticipate a movement and plan and execute a trade. Drawing what you want to see is always a good idea as a trader, not only because it allows you to share your ideas with your friends, but actually it helps with discipline. If you don't see what you've drawn, then you know you shouldn't be trading. The final one is wait. 90% of being a trader is waiting, so if you can't learn to wait, then you simply can't be a trader. If what you want to see doesn't happen, it's fine, just move on to the next idea. Otherwise, you'll be losing money. So in the case of gold, I know that I want to buy gold as the daily candle flips bullish and breaks this resistance at 1902. So what I'm going to do is actually use this path tool to draw what I want to see. I want to see a break of that level, a retest, and a continuation. Now my execution would be on the break of this high. I would define my stop loss below that low and target a 1-to-1 trade. Now that I know what I want to do, all I have to do is wait. If this doesn't happen, then I'll move on to my next idea, and I can set an alert here so that I know when the break is happening. I don't need to stare at the chart and wait for this opportunity to come. So that is it, guys. That is the trader's triangle. It's a really simple 3-step process that you can use to familiarize yourself with where price is at and find trading opportunities. I hope this helps.